morning everyone, this is Amit Pabari, founder and managing director of CR Forex. Next week, it is a week of central bank meetings. On 20th of September, we have Fed meeting. Entire market is expecting that Fed is going to pause the interest rate. Now that is already discounted in the market. What is more important is what is their stance for future rate hike. We are expecting that they will be either dovish or they will be neutral. Neutral means data dependent part. If that happens, dollar index will fall from 105 level to 104 or below that levels. Then on 21st of September, Bank of England meeting is there. Entire market is expecting that they are going to increase the interest rate by 25 basis point. And future also they are expecting that they are going to increase 25 basis point ka interest rate. Now that is already discounted. If any change in stance beyond 25 and 25 basis point happen, that is going to react the market. So we have to watch for BOE ka meeting. And on 22nd of September, Bank of Japan meeting is there. Now Bank of Japan meeting is very important as far as entire central bank meeting is concerned, because Bank of Japan is the only bank who has been saying that they are not going to increase the interest rate. Now if they change their stance and say that they are going to increase the interest rate, then we will see a reversal in USD JPY pair, which is currently trading at close to 147, 148 levels. If that happens, then USD JPY pair will move towards 145 kind of level, which is a positive indication for all Asian currencies. So according to me, the main meeting for the next week is Bank of Japan meeting, and we can expect a reversal in all Asian currencies during that point of time. Now let us discuss outlook for rupee. Rising crude oil prices, higher trade deficit, and dollar index not going below 104 levels. These are the prominent factors which is suggesting that there is a pressure on rupee. But the question remains whether this factor can take dollar rupee pair towards 83.5 or 84 kind of a level. Let me answer that in my following slides. Technical and quant model at CR Forex is suggesting that dollar index is trading at highly overbought zone. Any negative news from US economy or Fed sounding little bit of dovish can take dollar index towards lower level of 102 and 103. Second, Japanese yen is also trading at highly overbought zone. After BOG meeting, there is 80 to 90% probability that Japanese yen can move towards 145 kind of a level. If that happens, it will be a great news for all Asian currencies. Third important aspect is crude oil prices. Over a longer frame of time, we have seen that whenever crude oil price is trading above 95 level in last 2 decades, unless and until that period is of high geopolitical tension, the crude oil price fails to trade above 95 kind of a level. That is why we are expecting a reversal in crude oil prices. On the domestic front, stronger economic fundamental factors, inflows from Reliance and Adani, and RBI selling near 83.20 to 30 are all positive factors for rupee. On a weekly basis, we are expecting the pair to trade between 80 to 80 on the lower side and 83.25 to 83.30 on the higher side. But the medium term view remains the same, that we are expecting the pair to move towards 80 to 80 and 80 to 50 kind of levels. Now let us discuss strategy for thin margin exporters like agri exporter or a chemical exporter. The best part of knowing history is that it teaches us how we can avoid mistake which someone has made in the past. So let us go back to history. In October 2022, dollar rupee pair was trading at 83.21 kind of a level, and then US CPI data came, and immediately in 11 trading session the pair has moved towards 80.50 kind of a level. So this entire episode is teaching us one important lesson, that whenever the pair is trading near the top kind of a level, we should hedge 80 to 100% of our exposure. If anyone wants to wait, they should keep a strict stop loss of 82.90 and 82.80. If that is broken, they should immediately go and hedge. Now let us discuss strategy for thick margin exporters like textile exporter or engineering exporter. The strategy for them remains the same, between 83 to 83.30. If they are hedging based on anticipation basis, then they should keep a hedge ratio of 55 to 60%. If they are hedging against order, they should maintain a hedge ratio between 85 to 90%. If anyone wants to wait, they should keep a strict stop loss of 82.80. Now let us discuss strategy for importers. Last week we suggested importers that they can cover their near-term imports between 82.80 to 82.90 kind of a level, and last week rupee made a low of 82.83. For this week we will suggest them they can cover their near-term imports between 82.85 to 82.95 kind of a level. For medium-term imports, they can keep a strict stop loss of 83.35 and wait for levels of 82.5. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week. Thank you.